I want to express my gratitude to the Department of Justice, the SEC, the CFTC, and the Bahamian authorities for taking the critical step to hold Sam Bankman-Fried accountable for his misdeeds. I'd like to thank Ranking Member Toomey and his staff. Thank you for working with me and my staff to try to secure Mr. Bankman-Fried's testimony. I trust that he will soon be brought to justice. It's clear he owes the American people an explanation. Meanwhile, our job is to keep learning more about the collapses of FTX and other crypto firms, and I emphasize and other crypto firms, work with regulators to put consumers, not the crypto industry, first. It's not just about crypto, it's about protecting consumers, the regulated financial sector, from bad actors who think rules simply don't apply to them. 2.5 years ago, I explained why I thought Facebook's Libra currency was dangerous. At the time, Facebook was moving full steam ahead, as most of you know, to create its own currency. Put that in quotation marks, to impose on its billions of users. Congress, regulators, and policymakers saw Facebook Libra for what it was, a shiny new tool Facebook could use to reach into Americans' pockets and profit from, no matter the risk to consumers or to our economy. Members of this committee, others in Congress responded. Republicans and Democrats alike made it clear that Facebook couldn't be trusted. Our financial system was not to be played with. The risk of a company creating its own currency to compete with the U.S. dollar was obvious. Ultimately, Facebook shut down its crypto project, but the committee's work to protect consumers, of course, continues. Even though Facebook shelved its crypto plans in the last 2.5 years, the stablecoin market has grown 20 times to become a tool for rampant speculation. The number of crypto tokens has exploded, even as the total value of all crypto assets fell by two-thirds in the last year. I've noted in the past similarities that cryptocurrencies share with risky mortgage bonds and over-the-counter derivatives during the lead-up to the financial crisis. In all these cases, they told us how great innovation is and how derivatives make markets efficient. Wall Street made it easy for everyone to get a mortgage so bankers could create more mortgage bonds and increase profits. Making money in crypto seems so easy, too easy. Every crypto token could double or triple in value in a matter of hours or days. It didn't matter if it was created with vague details or as a joke, money still poured in. No one's laughing now. The weekend before our stablecoin hearing last February, we saw crypto companies spending big money on Super Bowl ads to attract more customers and pump up crypto tokens. I appreciated the comments of one of you in this panel on public radio today about that. Crypto, like Facebook's Libra before it, was the shiny tool supposed to capture our imagination and revolutionize our lives. Wealthy celebrity spokespeople told Americans, if you're not buying crypto, you're missing out. Crypto platforms created dozens of investment products that look and sound like bank deposits, using words like lend and earn, or tokens that resemble securities and have a yield or governance rights, yet these products had none of the safeguards of bank deposits or securities. Crypto firms, their backers argued that billions of dollars invested in lending programs or earning yield should be exempt from basic oversight and regulatory protections. That's not how regulation works. The things that look and behave like securities, commodities, banking products need to be regulated and supervised by the responsible agencies who protect the public and serve consumers. Crypto doesn't get a free pass because it's shiny and bright, or because venture capitalists think it might change the world, or its TV campaigns were witty and featured famous people, especially when so many consumers are at risk of losing hard-earned money. And that's before we even consider how crypto has ushered in a whole new dimension of fraud and threats to national security. People are talking about that more and more because it's a central issue in this, that support dangerous nation states, embolden criminals, finance terrorists. North Korea uses crypto stolen in hacks to finance its ballistic missile program. Think of that. Human traffickers, drug cartels, gun runners launder their proceeds using crypto assets. Think of that. And some of these laundered funds end up bankrolling terrorists bent on undermining our nation and our society. Think of that. The ability of rogue states, cyber criminals, terrorists to use crypto for their own malign purposes is a feature of technology, and that's the point. Crypto also has made it easier for fraudsters and scammers to steal consumers' money. Hacks and complex crypto transactions make it easy to steal billions of dollars of investors' money. That's what we saw with FTX. That's what will continue as long as we allow crypto firms to write their own rules. The myth of Sam Bankman-Fried and his crypto trading success was supposed to impress us. We're still learning how he shuffled money between FTX and his trading firm, Alameda Research, a name calculated to sound as generic as possible to avoid raising eyebrows while sending money across the world. FTX and Alameda Research took advantage of the crypto industry's appetite for speculation. They were able to borrow and lend from other platforms and invest in other crypto firms, inflating the crypto ecosystem and growing their own profits. Even this summer, as crypto values crashed and platforms began to fail, FTX and Alameda found ways to benefit. In one case, FTX made a $250 million loan to a platform. Using its proprietary token, and Alameda borrowed client deposits worth more than twice that from the platform. All the while, venture capitalists and other big investors, shame on them, fell for it. They were caught up in the speculative frenzy, missed the red flags, and FTX showered Mr. Bankman-Fried with more and more money, and now it's most likely gone. It's no surprise in 2018, Alameda solicited investors by guaranteeing 15% returns with no downside. That's more than the guaranteed 11% that a guy named Bernie Madoff offered. With Madoff and with Sam Bankman-Fried, investors didn't ask questions for fear of missing out. It's a good reminder that most guaranteed investments are, in fact, too good to be true. In this story, Bankman-Fried was the shiny object. Now he's the villain, possibly worse. But this story is bigger than one person or one firm, and that's the point of this hearing. It's not just about misconduct at FTX, but about how to protect consumers in the financial system from unregulated crypto projects. For many investors, it might be too late. I've heard from far too many Ohioans who have money stuck at FTX.us that they tried to get out before it filed for bankruptcy. But despite Bankman-Fried's assertion that the U.S. side of FTX should be fine, court proceedings are likely to drag on and on. If we're going to learn from FTX's meltdown, we must look closely at the risks from conflicts at crypto platforms that combine multiple functions. It means thinking about the kinds of disclosure that consumers and investors really need to understand how a token or crypto platform works. We can look to existing banking and security laws for time-tested approaches to oversee and examine entities that want Americans to trust them with their money. To protect consumers in the financial system, we need a comprehensive framework that looks at crypto products for what they are, not looking at these products the way crypto executives want them to be or want to tell us they should be. I look forward to working with Treasury Secretary Yellen. We've been working with her to step up and lead this government-wide regulatory approach, and the other financial regulators assure there's an all-of-government approach, just as we've done in the past. Anything less simply won't work. Senator Toomey.
Thank you, Mr. Chairman, and I want to thank our witnesses for joining us this morning. We're here to discuss the fallout after the collapse of FTX, and some Americans very likely suffered significant losses from the bankruptcy of FTX and Sam Bankman-Fried's misconduct. On Monday, we saw the arrest of Mr. Bankman-Fried, and this came as a surprise to no one, with the possible exception of Mr. Bankman-Fried. We owe it to each customer to get to the bottom of the FTX implosion, and any violations of the law should be aggressively prosecuted. The Department of Justice and other enforcement agencies should expeditiously investigate the unseemly relationship between a company that was effectively a hedge fund and an exchange entrusted with customer funds. While all the facts have not yet come to light, we've clearly witnessed wrongdoing that is almost certainly illegal. There was unauthorized lending of customer assets to an affiliated entity, and there were apparently fraudulent promises to investors and customers about FTX's operations. These are outrageous and completely unacceptable.
Yes, they're like.
The SEC also believes that FTX committed fraud against equity investors. They're going to pursue that, as they should. But I want to underscore a bigger issue here, and that is that the wrongful behavior that occurred here is not specific to the underlying asset. What appears to have happened here is a complete breakdown in the handling of those assets. In our discussion of FTX today, I hope we're able to separate the likely illegal actions from perfectly lawful and innovative cryptocurrencies. Now, it's important to define this space. Cryptocurrencies are analogized to tokens, but they're actually software. The software protocols that are foundational to the crypto ecosystem are like operating systems, and then applications are run on top of these operating systems. Currently, there are many competing operating systems and many apps running on them. There's nothing intrinsically good or evil about software. It's about what people do with it. And with this analogy in mind, What we should all understand here is one simple thing. The code committed no crime. FTX and cryptocurrencies are not the same thing. FTX was opaque, centralized, and dishonest. Cryptocurrencies usually are open source, decentralized, and transparent. To those who think this episode justifies banning crypto, and I've actually heard that suggested, I'd ask you to think about several other historical parallels. The 2008 financial crisis involved obvious misuse of products related to mortgages. Did we decide to ban mortgages? Of course not. A commodity brokerage firm run by former New Jersey Senator John Corzine collapsed after customer funds, including U.S. dollars, were misappropriated to fill a shortfall from the firm's trading losses. Nobody suggested that the problem was the U.S. dollar or that we should ban it. With FTX, the problem is not the instruments that were used. The problem was the misuse of customer funds, gross mismanagement, and likely illegal behavior. So let's talk about what comes next. Some of my colleagues have suggested somehow pausing cryptocurrency before we pass legislation. This is a profoundly misguided, not to mention impossible idea. Short of enacting draconian authoritarian policies, cryptocurrency cannot be stopped. If we tried, the technology would simply migrate offshore. Cryptocurrency does not need brick and mortar facilities to operate. And typing computer code should clearly be seen as a form of protected speech. Are we going to decide to pause the Constitution in order to stop crypto? This is exactly the kind of mindset that has driven this activity to the darker and less regulated parts of the world. Now, if Congress had passed legislation to create a well-defined regulatory regime with sensible guardrails, we'd have multiple U.S. exchanges competing here under the full force of those laws and regulations. In that scenario, it's not clear that FTX would have ever existed, at least on the scale that it did, not if we had American companies that were an alternative and properly regulated. The complete indifference to an appropriate regulatory regime by both Congress and the SEC probably contributed to the rise of operations like FTX. Others have suggested that we refrain from addressing cryptocurrency at all because we wouldn't want to legitimize its use. Well, I think that is both misguided and irresponsible. Congress can and should offer a sensible approach for the domestic regulation of these activities. I think we should start with stablecoins. This is an activity that my colleagues, we can analogize to existing traditional financial products. There's clear bipartisan agreement that stablecoins need consumer protections. There are virtually none in place now. I've proposed a framework that would do that. Senator Lummis and Gillibrand have also proposed a framework. Congress also needs to determine the criteria and the disclosures by which issuance of digital assets will be regulated. And we should acknowledge the possibility that there's certain token issuance, like Bitcoin, that don't need that kind of regulation. We should also clearly delineate regulations for the secondary market trading of these assets, including at exchanges like FTX US. Some of my colleagues have begun this important work. We can provide sensible consumer protections for which there would be very broad agreement while still allowing for the development of applications that are going to run on operating systems that we can't even imagine today, just as I don't think any of us ever imagined applications like Uber operating on iOS today. So let me conclude with this. It's absolutely essential to investigate any fraud and violations of existing law and prosecute those who are committing those crimes. Congress owes it to the American people to do so. But this is fundamentally not about the kind of assets that were held by FTX. It's about what individuals did with those assets. Individuals can be tremendously empowered by the use and access to cryptocurrencies. Cryptocurrencies can protect against inflation when governments irresponsibly manage their own currencies. They can provide useful services without the need for a company or a middleman. And they can let individuals preserve the freedom to transact privately. Mr. Bankman-Fried may well have committed multiple crimes. The SEC and DOJ will determine that. But let's remember to distinguish between human failure and the instrument with which the failure occurred. In this case, the instrument is software, and the code committed no crime. And while Sam Bankman-Fried very well may have, it's important we not convict the code of anything but preserving and protecting individual autonomy. Thank you.